Phil, the Fed is definitely in focus this week. U.S. central bank officials are gathering for a very important two-day meeting. They'll consider whether to raise interest rates after almost 7 years. Now, if they do, the implications for the U.S. and for the global economy are huge. Daniel Ryntjes.
The U.S. Federal Reserve manages something called the federal funds rate, which dictates the cost of borrowing US dollars for everyone. They've kept the rate at near zero, so the banks pass on the low cost of borrowing to consumers and businesses, stimulating activity and creating jobs.
Well, it's an historical event, right? Because it's been 7 years since the Fed cut rates to zero. For the first time, we are approaching a situation where a major central bank might be able to get out of the zero bound and start a process of normalization of interest rates. If they are successful, this would be historical.
Jobs growth has been impressive, but inflation, the increase in the price of goods and services, has actually decreased, partially because of lower oil prices recently. That's why some think the Fed may choose not to raise rates while inflation is so low.
If you look at their inflation forecast, they are not hitting their inflation target. Inflation target is around 2% over the next 2 or 3 years. That forecast is not there. There is no need to rush to do it.
Other economists think the Federal Reserve may wait a little longer because of uncertainty over whether the recent global turbulence will undermine US growth. Still, most economists think the Fed is likely to begin the process of raising rates sometime this year, provided the US economy maintains its steady course. Daniel Ryntjes, CCTV, Washington.